Hey, what's up, everybody? It is Thursday, March 18th. Bad day in the markets today, what can I tell you? But there is some good news. But first, I'm going to say something that you very rarely hear me say. I'm a little bit confused about what's going on, and I'll fill you in on exactly what I mean in a second. First of all, the good news, the stimulus money went out. I saw it in today's daily Treasury statement. So yesterday, 270 billion went out. I mean, some of you may have received your checks. 270 billion in one day. I mean, if you look at the chart, it was like straight up spending. So we are now like around 3.4 trillion in total spending, and we're up about 980 billion year over year. In other words, we're at 980 billion over where we were last year. So that's a huge fiscal injection on top of what was already a big fiscal injection. Let me talk quickly about bond yields. They shot up again today to a 14-month high. And again, I'm looking for some evidence of bank selling. And this is what I'm going to get into now. So far, most of the selling that I have seen is short selling by small speculators. I talked about this. If you look at futures open interest, if you look at futures commitments, small speculators have a record short position in the 10-year notes. And I suspect it has gotten even bigger since the last data release, which covered the period through last Tuesday. All right, that was what, March 9th or something like that? Here's the problem. I mean, we have just this week have seen a gigantic, and we knew this was coming, and I was talking about it. You know, we have seen a gigantic increase in bank reserves. Now, everybody knows about this now. This is not, I've been talking about this for 2 years, way back when nobody ever discussed it, about leverage ratios and bank reserves, and how this tsunami of bank reserves is going to maybe cause, banks to deleverage. What does that mean? They're going to have to either sell assets, maybe treasuries or other securities, maybe cut back on loan creation, or maybe have to raise capital. And we know at the end of this month, here's the part I'm confused about. Like, everybody knows about this now. We see what's going on. I mean, reserves as of yesterday, that's Wednesday, March 17th, in that 1 week period, increased by another 220 billion. Reserves are up to a record 3.8 something trillion. All right, massive. I mean, if you look at a chart of that, it's again another one of these straight up moonshots. So banks are having to deal with that. Now, 2 weeks ago, and I talked about this, we saw an addition of about 181 billion of reserves, and banks were net buyers of treasuries, okay? They weren't dumping them. So I don't know, we're not going to get to see these numbers now because the data is like a week behind, so 2 weeks from now. So I don't know, but here's the part I'm confused about. Like, what is the Fed and Treasury doing? I mean, they know that this is potentially a very disruptive problem for the banks. I mean, they have to adjust to this tsunami of reserve additions, and it may require some really massive deleveraging or capital increases. I just don't know. I mean, JP Morgan said, Jamie Dimon said in the fourth quarter last year, they are totally compliant with SLR, with the reserve, with the leverage ratio. And maybe the other big banks are too. And so far, I have to say, in the weekly data, I have not seen evidence of mass treasury liquid. As a matter of fact, it's been the opposite. They've been net buyers of treasuries, MBS, agencies. I've been saying that. So I haven't seen the evidence. But what I've seen now in this last week, in this reserve freaking, expansion that was like enormous, it might tip the scales. And if that happens, then we will see higher interest rates, and the higher interest rates right now are spooking the stock market. Now, this is all kind of technical because this stuff is going to end at the end of the month. The Treasury should have its account balance down at the level it was targeting, around 500 billion. It's at $1 trillion as of yesterday. So down, look, it peaked out in July at like 1.8 trillion. It's down to $1 trillion now. So 800 billion of disgorgement of those funds. Still got another, 500 billion to go. I mean, man, they did 200 some odd billion this week. So there's still potential for disruption. The good news, again, I got to get back to the fiscal. I mean, it's enormous, okay? And the problem is, I'll state it again, the inflation problem. And by the way, let me just say, oil was down 8% today, which is something I called for my subscribers. I told them to get out of their oil positions. In fact, I told them to go short the other day. So we did very, very well on that. But oil down 8% today, and it's likely going to go lower. I think you got to look at the low 50s. I don't know. To me, that doesn't look inflationary. All right? The dollar bounced back today. That doesn't look inflationary to me either. And here's something interesting. Gold was strong today. It went up on a day that you would expect to see gold go down because of weakness in equity markets and just kind of general weakness in commodity markets, but it went up. What is that? I've been saying it. What makes gold go up? The growth, the economic growth scenario. It's not about inflation. It's not about, a hedge against equities. It's growth. Gold responds to growth. And that stronger dollar today is another kind of growth signal, if you want to call it that. So the reason why I'm confused is like, what is the Fed going to do with the situation with the leverage ratio? Is it just going to leave it alone? They knew this was coming. They knew there would be potential disruption from this. So I'm just like looking at the whole thing thinking, like, what are you going to do? The exemption on reserves in the calculation of the leverage ratio expires at the end of this month, March 30th or 31st. So it's like, I'm looking at these guys waiting for some response. Maybe they're just going to let the clock run out, allow the Treasury to disgorge, that additional 500 billion and just kind of pick it up from there. I mean, once Treasury gets its balance down to where it wants, and once the banks, have acclimated to this new level of reserves, then that's it. All you have every month after that is the Fed buying 120 billion. And, I don't even know why they're doing that, but, things stabilize at that point. So we'll have to see. I think the fiscal remains a bullish picture, but I'm confused as to policy right now. Like, what are these guys doing? They knew it was going to happen, and it just kind of looks like they're letting it happen and let the chips fall where they may. All right, so anyway, I sent out a bunch of emails today. If you want to get those, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trader. Remember, I'm the only one who has an applied approach to MMT. I take the concepts and understandings of MMT and I use them to invest. See you tomorrow. Bye-bye.